When you get to retirement, do you know how to protect your portfolio from the dangers of inflation? Hi, my name is Dave Grant. I am the founder of Retirement Matters, and this is the 5-Minute Retirement Plan podcast. Every episode is supposed to be roughly 5 minutes long. Don't hold me to it. But that is a way that we can touch on areas that may be of interest to you. And if you want to dive in further, then you can reach out to me and we'll go through it. So today, we are talking about the dangers of inflation when you get to retirement and start living in retirement and withdrawing from your portfolio. So let's give you that basic understanding of what inflation is. Inflation is the increase of costs and goods over time just based on life. Now, the tough thing is if you like holding cash, cash is going to be eroded over time by inflation. So essentially that means, if you have $100 today, it was worth a heck of a lot more 10 years ago when inflation was lower. So eventually inflation just kind of wears away at the dollars that you have. So you can't really hold it as cash and expect it to last you a long time. So how are you going to protect your retirement savings from inflation? Well, we just touched on it. It can't be in cash. You have to invest it in securities, whether that's stocks, bonds, or CDs, something else that gets you a rate of return or a rate of growth that is higher than the overall percentage of inflation. So if inflation is 3% per year, you want investments that are doing more than 3% per year. So essentially your money is growing and it's not shrinking due to inflation. So let's talk about some ways that we can do that. Now, if you need to hold cash, say you are preparing for the next couple of years of your income and you want that pretty secure, you're going to be looking at high yield savings accounts. You're going to be looking at CDs. And you can do a quick comparison as to, okay, well, what is inflation right now? Let's say it's 3%. What is my high yield savings account? It's 4.5%. Okay, for the next short-term period, that is going to allow me to keep pace, and also outpace inflation for the short term. Is it going to do that for the long term? It's not, because inflation is going to go higher than 3% sometimes, and cash is not going to be able to keep up, and so your money is going to start to shrink. Now, if you are sensitive to inflation, there is a certain type of bond that you might like. It's called a Treasury Inflation Protected Security. So it's called a TIPS. And what that is you buy a bond, the rate of interest is set, the value of the bond will then fluctuate with inflation. So essentially, if inflation goes up, the value and the payment of your bond is set to go up as well. Now, sometimes they work really well. Sometimes they don't work really well. Just depends on what the inflation is and what the general stock market is doing as well. Now, let's put TIPS aside. Regular bonds do a similar thing in terms of they don't specifically tie themselves to inflation, but the interest rate that they have typically outpaces inflation in the long term. Now, if you want to do that, you typically have to loan your money for a longer period of time to get a better interest rate. Now, when we're looking at cash, TIPS, CDs, and bonds, you are limited in how much that money can grow based on the interest rate that you're going to get. Bonds typically don't grow as well as stocks do because that's just the type of financial instrument that they are. So if you're looking to really outpace inflation in the long term, you need to be investing in the stock market. So that's the US stock market and the foreign stock market. And it's going to be countries and companies all across the world. And it's going to get you a better rate of return over inflation over the long period of time. Now, I hear from people when I tell them to invest in stocks, they're conscious of the risk that comes with that. What if we go through market downturns and I start to lose money? Or what if I invest in a company and it goes bankrupt? All these different things are valid concerns. But when we're investing in a portfolio like this that is designed to beat inflation, we are using it with a retirement income plan as well that's designed to create income for you in the most conservative way. So we're looking at a number of years in cash set aside that we can put in a high yield savings account. We're looking at funding that cash over a period of years with short-term and intermediate-term bonds. So we're not actually touching the equities for a long time. Now, if you look historically, if you leave equities alone for a long time, they will have a positive rate of return, and that positive rate of return is essentially going to outpace inflation, hopefully, in the future. So what do you do if you're not sure about building this portfolio? Well, that's where financial planners like myself come in. I can help you build a portfolio that is geared for your retirement income. It will make sure that it's outpacing inflation, hopefully. Definitely no guarantees, but it's designed in a way that it's built for the long term to outpace inflation for the long term. So if you have any questions, my name is Dave Grant. My company is Retirement Matters. You can reach out to me there and ask any questions, and I'll see you on the next video.
Dave Grant is the founder of Retirement Matters, a wealth management firm in Barrington, Illinois. Dave specializes in helping people transition into retirement, specifically executives at AbbVie and Illinois teachers in the TRS pension system. If you have concerns about your retirement transition and want help from a fee-only advisor with decades of experience helping people like you can learn more at www.retirementmatters.co.